Rumen is focused on developing the Romanian market for Launchub ventures, as an addition to the fund's scouting activities in Bulgaria and Southeast Europe. Before joining Launchub Ventures, he had his own business consultancy practice, helping companies in their management to solve issues and achieve various business goals. During his professional career, Rumen has held many positions in management consulting, utilities, insurances, financial services. So this is the guy with numbers, and he will show that to you. Rumen, without further ado, I'm giving the stage to you, and tell us a bit more about the metrics and the KPIs.
Thank you.
That we need to consider in our fundraising and then reporting to the startups. I never do that. I really should listen to you very carefully.
Thank you, Ina. So hi everyone. My name is Rumen. I'm also Bulgarian, although my English is not as good as Irina's. So you're going to be suffering my Eastern European pronunciation for quite some time now. So we have 30 minutes, and we are already running late. So let's start. Maybe one interesting thing about me, I've never missed a Textilvania event in my life. So I've been coming to Cluj even before Textilvania. So I was a proud member of the first startup weekend 10 years ago here. And since then, I fell in love with the city. And I'm quite regular. So unfortunately, due to the COVID, I was online. So I'm happy to be back. Thank you all for coming and listening to this short presentation. Few things about Launchub. So since some of you may not know, we are a regional venture fund, started 2012. We are already investing from our third fund. So it's, I mean, the first one was called Beta, since, it's like we weren't sure we'll become a VCs. That's why we call the third fund, fund number 2. It's a bit confusing. But what's important about it, it's like 74 million euro active investing in the whole region. Currently, 4 startups founded by Romanians in our portfolio, only in the last fund. So we are very proud to be able to partner with some of the best entrepreneurs here and hopefully support them in their journey. Yeah, so this is more or less about Launchub. You can see some facts here. So we're investing in seed stage somewhere between 300,000 and 3 million euro only from us. Leading rounds, co-investing, doing whatever we can to actually support you as entrepreneurs. Good. So without further delay, as you all heard, I was a consultant before. It was 10 years ago and more, 12 years ago. So I still have some habits. I'll start with some disclaimers. So what I'm saying here is the following. First of all, I don't know much about the things I'm talking about because I'm a VC. I'm not an entrepreneur, so I know them better. Second of all, as a VC, we're going to take the things lightly. That's why we have a surfer here. And you can see the surfer is in a good waters, no waves, investors. So everything is calm. You're the entrepreneurs. You'll be fighting with the waves, right? So if you have any questions, I don't know if there will be a time for questions, but I'll stay after that, after the 30 minutes are gone. And if you have any questions, you can talk to me. So I'll share things from my limited experience. So we have invested in, I don't know, 70, 80 companies over the last 10 years. Let's see what we can share about metrics further on. Be aware that I'll be addressing B2B mostly. I'm not going to be addressing marketplaces or B2C. I'm going to be addressing SaaS businesses, the usual suspects. And I'm going to be talking about early stage, so seed and Series A, because Launchub job and our job generally is to work with you to get you to Series A and then probably work with you to get you to Series B, and then more or less our job is done. Now, so metrics, last year at the Textilvania event, I had a small workshop about fundraising metrics. So basically, what are the different metrics we as an investor look at when we are making investment decision? And those metrics, of course, are different at the stage of the company we're investing in. So of course, if you're early stage and you don't have revenues, it's very dumb to ask you for revenues, right? So obviously at the bottom, you can see that we're looking at a credible problem, big market opportunity, good team, obviously. It's good not to invest in crooks, and it's good not to have crooks on your cap table. Also, investors in this apply. So then, when the company progress, we look at engagement and usage. If you have some early traction with users, if you start having some paying customers, then we start looking at some metric regarding what's happening on the financial side of the company. So basically, we as investors, we would like to get a sense on the financial picture. So that's why these metrics are important for us. So when you have the first paying customers, then we start looking about churn, and we start looking about annual contract value, just to be sure we understand to what kind of a customers you sell. Do you sell to big enterprises or to small companies? Obviously, if you're selling to SMEs and small companies, you have larger churn, that's expected, and so on. So benchmarking generally in those KPIs is done based on AVC, or average contract value, and also the KPIs, if we just look at the static picture, they won't tell us much. We need to see the dynamics. So it's the change, the percentage change in those metrics that matters, right? So you can imagine that when a company is having the first paying customers, keeping them, so the churn is one of the key metrics, right? And there's some other things we look at. So we look at the gross margin, payback period, sales cycles, and customer growth. Look, last year I did a lot of formulas, and many people shared it was like very insightful, and there was a lot of content. Now we're gonna take it lightly. So there'll be very little formulas. All those KPIs are available online, so you can check them out. They're not so important at that stage, right? What's important is to give you a perspective why some KPIs here matter more at some certain stage than others. So for example, when you start scaling your sales, then obviously your growth in recurring revenue, if you're a SaaS business, starts mattering more. So MRR, but in particular new MRR, for example, matters more than your MRR, especially in your seed stage. Because we don't care how your company is growing, but we care about how much money you get from your new customers. So if you're only growing your MRR because your existing customers are expanding, probably it's not so sexy than just acquiring new customers, right? So the new MRR is getting more important. And then this balance between lifetime value of a customer, or LTV, and customer acquisition costs, right, becomes really important. And I guess most of you, if not all of you, have heard about it. The rule of thumb is simply that your lifetime value, or all the money you get from your customers from the moment he subscribes to your services to the moment he churns, compared to the customer acquisition cost should be more than 3. That applies, and so on. Also, we're quite interested to understand if you retain your customers, if they upsell, if you're able to upsell them. So this is the net retention, and so on. Now, in the growing stage, obviously other things are more important. So basically, we start to think about your growth in general terms. So now we start to be more like, look more in the numbers of the company more on as a financial investor. So we care about growth, big gross margins, big things. Payback periods important because usually when the companies grow, they start selling to larger customers. This means like a longer payback periods and so on. And at the end of the day, when the company is growing, the team that we said here at the beginning, the great team is not so important. Actually, having a good moat. The moat is this water barrier around your castle, around your company, is becoming more and more important because at the end of the day, when there is a castle in the capitalist world, somebody would like to take your castle and do what you're doing. So you better have a good moat around it. And the team is getting less important because when the company goes public and so on, sooner or later this company will be run by idiots. So it's better to be a good business. And the team can even retire at this point, right? So as you can see, with the growth of the company and with the development of the company, different metrics actually probably are more important than other metrics to pay particular attention at. But since we're going to focus on the very early stage, so seed stage and Series A stage, let's start with very, very simple things that are really, really basic. Now, so the first basic things I would like to introduce is the dynamics of a car dealership. So the car dealership does the following thing. The car dealerships sell cars, used ones. So what are we doing now? We're selling cars. Imagine we're selling a car and one car costs €1,000. And we have customer acquisition cost of €500, right? So selling a car for €1,000, these are our revenues. Our customer acquisition cost, because we put some newspaper advertisement, and we put some web advertisement, and usually costs us, some money to acquire a customer to come to our dealership to buy a car, is a €500. So now we can say that our LTV is twice our customer acquisition cost because LTV is just one-off sales. There is no lifetime value to consider. We just sell the car and that's it. This is all the money we get from the customer. So this is all its lifetime value, 1,000. And then we have this customer acquisition cost 500. So this is like 2 to 1, right? So it's starting to look healthy, but we're missing something, right? So we're missing something very important, and it's the gross margin. We're missing the fact that we are paying for the car to buy it and then to sell it, because it doesn't come from free. So obviously we're buying used cars. So in the reality, we pay $500 for a car, and then we pay $500 to acquire a customer, and then we sell the car for $1,000, and it's zero cost, zero money left to cover for the assistant, to cover for the phone calls, to cover for the gas to go to work and so on. And we can try to scale this model, but the more we scale the model, the more money we're going to lose in our car dealership example. And I'm making this point here for a simple reason. Many people are underestimating the value of gross margin. So yeah, we do a SaaS business, come on. Like what I have in a gross margin, I have some services, cloud, usually servers. I have some sysadmins to keep the website from falling down if I have too many customers coming. Usually, it's negligible. I mean, it's like, usually the gross margin is, the cost of goods sold that I need to subtract from my total revenues are only reduced with what I need to pay to serve my customers. And in SaaS business, it's very, very little. But it's not always the case. So basically, there are things that we should look at that can eat something like 20 to 30% of all your total revenues. I'll give you a simple example. Imagine you have a mobile app and you're selling and you're making your revenue through, App Store, and you don't have any way around. So App Store will take you like, 20, 30%, right? So your margin is actually, the revenues you're getting after you deduct your margins may not really be as high as the revenues you're getting from your customers. Now, we also have something here called lifetime value, right? So the lifetime value at this point is the average revenue we get from a customer multiplied by this gross margin that we are always forgetting. So it's more or less 80% of the money you're getting from the customer, divided by the customer churn rate. Now, the customer churn rate, so, when you go to the literature and you start looking into what churn rate I should use to be able to calculate my lifetime value, what you're most probably going to bump into are two different churn rates. So one is called the MRR churn, or the revenue churn. So this is how much revenue I'm losing. And the other is called the customer churn. So how many customers are churning? Let's make it simple. Imagine we have 10 customers. Our business has 10 customers. 9 of them pay us €1 per month. 1 of them pay us €11 per month. Altogether, we get €20 from our 10 customers. And they're churning with a churn of 10% a month, meaning we're losing 1 customer a month. In 10 months, we're going to be out of customers, right? We're not acquiring new customers, so we have a churn rate of 10%. We're losing 1 customer a month, and slowly getting rid of these 10 customers that are still paying for our product. Now, the first month, we're going to lose 1 customer. So 1 out of 10 will be gone, and if this customer is paying in €1, that's good. But what about if this customer is paying €11? This should be the whale in our calculations here. What you need to understand is that at the end of the day, the lifetime value of the customer is this money we are getting from them. This average money from the 10 customers is €2 because they're giving us 20 altogether, divided by this 10%. Because we have a churn rate of 10%. So at the end of the day, we have lifetime value of 20. So we get 20 during the lifetime of the customer. And if we lose the customer that is paying us the most, what will happen is that this average revenue we're getting from a customer will fall down. It's not that we need to consider the churn rate in a different way. We don't need to look at the churn rate of the revenues. What we care about is the churn rate of the customer here in this calculation. So it's, if we have any changes in the revenues, they'll be reflected in the top, in the numerator of this equation. Now, payback period is usually the average time to recover your customer acquisition cost. And what does it mean? It's like when you spend some money to acquire a customer, so let's say you spend $500 to acquire a customer, and this customer pays you $100 a month. in the next 5 months, you'll be recovering the initial costs you have spent to acquire this customer, right? So these are simple concepts. But they need to balance. And this is the whole journey of the surfer here, is the balancing of the two things, right? So with one of the legs this surfer is having on the surfboard, he needs to press the customer acquisition cost down. And with the other legs, he needs to kind of try to lift the lifetime value of this customer up to be able to have this healthy unit economics in the business. And imagine that, as we said, the customer acquisition cost is the cost we spend to acquire a customer. So the usual suspects in these equations are the sales and marketing expenses, and usually the mass marketing or having expensive sales. But what is happening with the customer acquisition cost when we grow the business? When we grow the business, the sales complexity increases. What does it mean is that, like at the beginning, you probably have this no-touch sale approach. Like a website, people come, buy, and that's it. You don't really have to communicate with them. Further on, with your desire to increase the lifetime value of the customer, naturally, you're gonna go and you're gonna target bigger companies, so bigger customers, but they would like to call you on the phone. So you need a person to pick up the phone, obviously. They would like to ask you questions. So you need to have a person replying to these questions, right? They would like a demo. So then you need to have a person to make demos, right? And this increases sales complexity. So you're moving from this no-touch approach to a low-touch approach, right? To inside sales. But when you move to inside sales, what's happening with your customer acquisition cost is that they're growing up, right? So with one hand side, with one of your legs, you're trying to lift your lifetime value, moving up. You're trying to move up and serve a higher tier of customers also to reduce churn and so on. But what's happening actually is that your other leg is not pressing hard enough on a customer acquisition cost. And what happened with the surfer in this case, if he's not careful, is he's going to fall off the surf. Especially if sales and marketing go really out of control. And when the surfer falls off the board, he may drown. And we as investors, we get very disappointed. Yeah. And then now, there are also other balancing things here. So when the complexity increases, the sales cycle increases. So the sales cycle is measured from the moment a lead comes to your CRM to the moment the lead is closed. And this sales cycle will start getting longer and longer. And then let's say, okay, I need to calculate the CAC from the customers I acquired this month. But basically, the customers that I acquired this month, the expenses were done in the last 1 year, for example. Because my sales cycle becomes so long that it becomes 12 months. So in the last 1 year, I need to calculate all the people in the sales department that work for this customer to convince him to buy the product, all the marketing efforts that were done. Okay, maybe you can say not all of them because some of them work for the brand and so on in the future. But you understand what I'm saying, right? The longer the sales cycle, the higher the salaries were paid for the salespeople, the higher, even your CRM is built monthly, It's like if you prolong your sales cycle with 1 month, just the cost will basically continue to grow. And you're going to lose the balance, you're going to fall, I'll be disappointed, and so on. And at the end of the day, we told to our investors and LPs that we invest in excellent surfers. We don't want them to, all of them die drowning. Now, and on the other hand side, you balance this. You balance this by acquiring new customers, right? So, because the customer, at the end of the day, the customer acquisition cost is divided by the number of new customers. So the more customers you have, the lower the CAC. But when you're growing, and you're growing fast, each customer is more and more expensive. So it's actually a bit of a paradox. You have to grow fast, but you're spending a lot of money, right? And your sales cycle is growing longer, and your sales and marketing expenses are growing. So at the end of the day, customer acquisition costs are growing. The sales complexity is growing, and you're losing balance. And this is exactly the fine-tuning. So it's like, shall we press the pedal to the metal and spend as much as we can and grow as fast as we can? maybe, especially if the VCs are around and they're able to cover this, yes, but maybe at one point, if you're not following this balance, this can have dire consequences. Now, this is offset by this lifetime value of a customer. So lifetime value of a customer is basically how much money you're getting from the customer, right? This is the other leg. So we're trying to lift this up, lift it as much as possible. So we're trying to reduce the churn rate. The lower the churn, you know, the longer the customer stays with us. The more and more months or years this customer is going to give us money, right? So it's an easy concept. And we're trying to lift this average money we're getting from a customer. So if the customer stays with us 10 months, but he pays us $200 instead of $100, well, it's twice the lifetime value. The more money the customer pays us, again, this balances the sales cycles, usually. So it's, again, it's like you have to balance the surf. It's not only understanding the metric, but understanding how the metric affects your business, right? And then it's this gross margin again here. Because the lifetime value, as we said, is not only the money you're getting, but it's the money you're getting multiplied by your gross margin that matters, right? So this is the balancing of this unit economics that we pay attention when we grow our business. And then this balancing game continues with the growth and cash. So the more you grow your company, you can see here. So the blue line is your first customer. And it starts below zero line because it's your customer acquisition cost. It's your customer acquisition cost, the customers start paying your subscription revenue, and then you're growing. And then you have a second customer. See, the second customer, so the customer acquisition growth, the customer acquisition costs are increasing, but your growth is steeper because you have two customers. And then you have the third customer, you know, it's like purple or rose arrow there. So you see that the customer acquisition costs are growing. I mean, like more and more, and that's why you spend the investors' money for that. That's okay. This is what we would like you to do. And then we are expecting that at one point, this arrow will become steeper and steeper. You're going to achieve this hockey stick, and we're all going to be happy. But it all depends, again, on your life cycle. So on the time to recover your customer acquisition costs. Or basically, this is, again, when you're spending money to acquire customers, the time to recover this money is the counterbalance of your growth. So again, if you're not careful, what's happening over time is that at first you're saying, okay, I'm acquiring a customer for $100. He pays me $10 a month. In 10 months, I'm recovering this amount. But what about if the customer pays you $5 a month? So you're going to recover not in 10, but in 20 months. So this cycle becomes longer and longer, and then you lose balance. You fall, you drown. Investors get disappointed. And there are usually some benchmarks here. You can say, yeah, in the usual CAC business, that is not really enterprise sales. If you're recovering your customer acquisition cost below, within 12 months, you're fine. If you're having this heavy enterprise sales, maybe you'll be recovering your customer acquisition cost within 1 or 2 years, or 3 years sometimes, right? But the longer the cycle of recovering, the sluggish will be your growth. So this is what's happening actually here. So you're acquiring more customers, but instead of this picture up there, you're getting this picture. So more and more customers with a very, very sluggish recovery of CAC will result to larger and larger burn rate with very, 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 very sluggish recovery after 10 years. Investment funds are usually capped on 10 years. They don't have this time. You may not have this time as well. So basically, that's the balance between growing, acquiring customers, and having your cash in the bank. Spending money on customer acquisition costs and balancing this recovery of the CAC. Because if you remember, the more complexity you build into your sales model, the more complexity, the longer the life cycle. The moment you have to play golf with your customers to convince them to buy, you have life cycles in years, right? When the life, and then the recovery of your CAC will grow longer. And then you'll be out of balance. And Yeah, we used to live in a time where investors like me were very nearby. So I don't know how many of you remember the previous crisis. The money were available, they have been always available in the last 10 years. The money has been, have been cheap. But if you don't have investors nearby or a way to raise, this can kill you. And now in this economic cycle that we are coming in, this can be deadly, right? So this has been our surfer balancing on his surf with the very, very, very basic metrics. I think we still have time. We started late.
I just wanted to encourage maybe also the audience to think of questions because we won't have much time for it.
All right.
Yeah, continue.
Can I continue to take my 30 minutes? I think I have 5 more.
Yeah, go on. No
Very,
worries.
very quickly. So basically, yeah, these are the metrics that I mean, the big picture KPIs, a few words about reporting, okay? We as investors, we would like to very quickly grasp what's going on in the company and how this surfer is balancing on the surf. To grasp this, we usually ask companies to report. So it's not only for us. I mean, at the end of the day, if you are a startup founder and you're not really looking into what you're doing, you may end up falling out of the surf and disappointing everybody. Now, the big picture KPIs are clear. We discussed them. So obviously, growth in your recurring revenue business. Again, with exception that you need to pay attention to your gross margin. How many customers you grow, because the growth of your business can come from your existing customers, but we do care about your new customers, not the existing customers at the seed stage especially. Now, average customer value, how you're expanding, do you acquiring customers that can pay you more, are you moving to different tiers? Churn, of course, an MRR churn for the first time, yes, we care about the MRR churn. CAC and LTV balance. Now, detailed picture, we can go deeper, right? We can go, for example, to understand, are we really growing the MRR? Because MRR can be growing, but at the end of the day, if we have churn, if we have customers not expanding, but what's the opposite of expanding? Like contracting, they're spending with you. You can end up at the end of the day having some net new MRR, which is in negative numbers, meaning that your churn will be higher than your new MRR, right? Again, we care about retention, and we care about the retention of the MRR in this case. The whole idea of KPIs, when you have them, when you understand them and balance them, is to be able to simply report them. Over the years, we have seen companies experimenting a lot with reporting. Many of the founders are going into PowerPoint presentations and trying to make fancy things that take some of their time, and it's bad. I mean, at the end of the day, you're wasting your time. Keep it simple. That's a simple example of a reporting. So there's some KPIs that are bolded. So these are the big ones. That at the end of the day, give us a idea if the company is growing, if this month is good, if this month is bad. And then there is some detailed KPIs that are telling us if you would like to look into what exactly is happening and get a more detailed picture. We can basically get this from the KPIs that are not bolded here, right? And that's completely sufficient with few lines of explanation. What's going on? And this is all about reporting. You don't need to be really precise not precise, but you don't need to be really detailed. You don't need to make it beautiful. Make it simple, right? So I'll finish with one tip on how to compile your KPIs. What usually happens when we invest is that the companies are like, well, you know what, we're going to build something that actually does this for us. Because we're builders, right? So we know how to build stuff. We know how to build software. So we're going to do this internal tool, right? Well, this is usually the worst possible solution. It doesn't take 2 months. It usually takes 2 years. And then when you really build it, it's useless. It happens usually 50% of the cases. And then it's scrapped. Then the suboptimal solution is where you buy a software. You buy HubSpot, and it's like, oh, I have all my reporting there. Not really. I mean, like what portion of your marketing expense you're going to put in your customer acquisition cost? All of it? Or maybe early stage, your marketing will be towards building a brand, building awareness, I don't know. So it's like, maybe you can subtract some of it. And who's going to do this? This is going to be done by Maria, or this is going to be done by Dan. These are the most optimal solutions. So you have an analyst. You hire a CEO assistant. And then remove 20% of our marketing expense. Because this marketing expense doesn't apply to the customer that we acquired this month. It's going to apply to the customer we acquire in the next 2 years, right? So we need to adjust here. This is it. So it's very, very simple. But it's all about balance. You cannot go pedal to the metal unless you have unlimited amount of cash. If you increase your sales complexity, you increase your customer acquisition cost. If you increase your customer acquisition cost, you're going to fall off the surf, right? You're always trying to increase your lifetime value. You're always going to try to increase the annual contract value, the average annual contract value of your customers. So selling to bigger and bigger customers to have lower churn. The bigger and the bigger customers need more care, so they need more costs, and you need to balance, right? That's it. 20 minutes. Thank you. So,
Wow, Rumen, that was very, very
That was
impressive. And that was also fast, especially for the complex topic that you have. I still promise that we're going to have some questions. Maybe the colleagues in the back can help me with the micro. I'm going to allow 2 questions because...
Don't forget, I was just the, how do you call it, the band that warms up the audience before the main event.
Exactly.
So I don't want to take the time from the main event.
You definitely managed to do that. You gathered us all up here in the 4th floor. Do we have some questions at this point? Yes, there is one in the back. Can someone help me with the micro? Okay, great.
I already have one. Hi.
Maybe you can also introduce yourself very shortly and then ask your question.
Well, I'm on camera with the irresistible haircut. I'm Emmanuel. Hi.
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 Quick question. I'm in the robotics for construction business. We do a few robots for construction. We will have a robot as a service way into the market. Investor-wise or VC-wise, I have always asked myself, what is most important to you regarding profit, context? If you say we do a turnover 100 million and we get 1% profit, it's just 1 million. But if we do 10 million with 80% profit, then it's an 8 million profit. What's most important in this area for you?
Very quickly, that's a very good question. So first of all, in the VC world, everybody has its own opinion, right? So I'll give you mine. I don't like profitable companies. So we don't invest in profitable companies. If you're investing in a profitable companies, you're not growing fast enough. You're not spending you don't spend enough money on your customer acquisition. So that's why you make a profit. So the profit is not important, the growth is important, because somebody else will make the robot will become very famous. It will take all your market, and at the end of the day, you have your robot, it will be better, but you won't have a market. So the market is more important. But if you have a robot and you sell a robot, it doesn't sound exciting. Exciting is you have it as a hardware as a service. I'm not going to sell you the robot. I'm going to give you the robot, and you're going to pay me X amount of money forever until the robot works, of course. And of course, in this hardware as a service, you're going to include the maintenance, making sure the robot works. Now, the profit margin, it's not so important. It's not one-off sale. What's important for you is to find capital, because you'll be expensive business, because you need to put operational capitals. The VCs don't want to invest in the operational capital. You need kind of a debt financing to finance the hardware. So very quickly, it's investable. We do have hardware as a service company. So Giraffe 360, for example, from Latvia is hardware as a service company. We've done it traditionally, but we don't invest in companies that are actually selling hardware per se, right? So I don't know if I answered the question, but it basically the profit in this case doesn't matter. So the profit margin in this case, although important, it's not so relevant than if you can make really big business through making the robots really available to everyone with a lower price monthly.
So what I get from here is that scaling up lightning fast is better in this stage, as you see it, than profit.
There is a timing in everything in the world. There is a season for everything. It's a verse from the Bible. Season to see it and so on. Look, do you remember Google Plus? It was like
not really.
Yeah. Google tried to enter the
Good
social
point.
media a bit too late. Do you remember Microsoft Mobile? Yeah, so basically we had Google and Android, and there was Microsoft was like, hey, what a nice market I'm going to enter. Yeah, too late. So basically if you're saying now we have a robot now, very cool, ask me in 10 years. I'll be like, yeah, do you remember this company? Try to enter the market, it was too late. So yeah, growth matters.
Thank you
Growth
very
matters
much.
now.
Very cool. We have another question here in the front.
Hi, I'm Sergiu Neguț. I'm one of the founders of FintechOS.
On the T-shirt.
T-shirt. And I can tell you, Rumen is present on our board from the very beginning, from the seed stage, and he was an absolutely fantastic advisor because you have all these discussions that are down to earth, and they are really based on reality, and at the same time are taking the company where it should be. And my question to you is, because I have to ask a question, what are you looking for? What kind of companies are you looking for to invest in right here?
Bold
Very
ones.
relevant for the
Sergio, we're
audience.
looking, thank you for the question. We're looking for a bold founders with a big vision. So it's like
But not profitable.
not the typical shy Eastern Europeans. We are typical shy Eastern Europeans. I mean, come on, I come from Bulgaria. So yes, we try to look for something really bold and really hairy, like something that really, no, you're not a blood. That's, okay, that solves a hairy problem that can grow big, right?
This is like when you ask a woman what does
But
she want in life.
thank you for the nice words. Like, you're very kind, like always.
Rumen, that was amazing.
I was paid to wear the T-shirt. No, I'm joking. It's like, yeah. Okay.
I can finish up with a last question. Yes. How do you identify a premature scale-up?
So investors, I didn't say it because I kind of this talk was stepping on a previous talk from last year, so I didn't talk that. But they're benchmarks, right? So I mentioned the most obvious one. So like in each stage of development, the investors try to benchmark to other companies they've seen and to other companies they've invested, the KPIs you are discussing. Mm-hmm. So basically, and nowadays even more importantly. Because the money are more scarce, you see benchmarks like, okay, what is the revenue per employee you're making at this stage compared to other companies, right? Did you overscale your employee? So how much is your customer acquisition cost and how is development? Because this is what you can scale prematurely, right? If you're not getting the customers, if they're not buying, and you're still educating the market, but you're scaling the costs, you can scale prematurely. Mm. So yeah, it's a benchmarks. Mm. So I mean, rule of thumbs. So yeah, can you return your customer acquisition cost in 12 months or no? Like, of course, I mean, average SaaS business, B2B. So yeah, so that's what investors do. I mean, they don't know usually. We don't know, but we try to benchmark.
Rumen, thank you so much. You'll stick around, I think, till tomorrow, so you'll have the opportunity to ask him questions also in person. Tell him about your bold ideas. I think this is what he's looking for, but also the hairy ones. Yeah. We're going to have a very, very short break just for the technical setup for the next speakers. Give him a big applause, please. Come on.
Thank you. Thank you.